In this video, I'm going to show you how to record post-retirement benefit expense and make the associated journal entry. So let's take the company Bicycle Seatbelts. They've got an unfunded retiree healthcare plan. So that means if their employees work 10 years for the company, they're able to retire and get healthcare benefits from the company. Now, at the end of 2024, the company hires an actuary, and they say the net cost of providing those healthcare benefits to the retirees after accounting for the present value will be $800,000. So that's going to be the EPBO, the expected post-retirement benefit obligation, as of December 31st, 2024. But we will get to that. Okay, now the employees need to work 10 years to fully qualify for the benefits. So that 10-year period is called the attribution period. We'll come back to that as well. And at the end of 2024, the employees have worked 2 years. They're expected to work for the company 25 years in total, and we've got an interest rate of 5%. So the question is, what is the post-retirement benefit expense for this company? How much should they recognize for the year ended December 31st, 2025? And what is the associated journal entry to record that? So we're going to get to it, but let's start out with how do we even calculate post-retirement benefit expense? Similar to accounting for pensions, we have 5 components. Okay, not all 5 of the components are always present, but we're going to have service cost is going to increase post-retirement benefit expense, and we're going to have interest cost is going to increase post-retirement benefit expense, and then we're going to have any expected return on plan assets is going to decrease post-retirement benefit expense. In this example, we said this is an unfunded plan, so there are no plan assets, so the expected return is going to be 0. Now, this example did not mention any amortization of prior service cost or amortization of net gain or loss, but you could have those in certain examples. Now, a couple of differences between this and accounting for pensions, because you see the same 5 things and you might be thinking, okay, this is identical to accounting for pensions. Number 1, service cost is going to be calculated differently. I'll show you that in a moment. And number 2, if there is any prior service cost that's being amortized, when we come to other post-retirement benefits, like a healthcare plan, it's going to be amortized over the time remaining until full eligibility. Okay, so the time that is left, how many years are left for the employees to be fully eligible for those healthcare benefits. That's different than if we're dealing with a pension. If we're accounting for a pension, we're talking about amortizing any prior service cost over the time to retirement. Okay, the remaining active or the remaining years of service for active employees. So that's a difference. Okay, we don't have any prior service costs in this example, so it's not going to be an issue here. But if you look at, for example, in the given information, the employees expected to work for the company 25 years. If we did have some prior service costs to amortize, we would not pay attention to that. It doesn't matter for a healthcare plan. We care about how many years are left until the employees would be fully eligible, and that's the time horizon over which we would amortize any prior service costs. But we don't have prior service costs in this example, so let's move on. Let's get back to our example. Now, I've got the EPBO and APBO calculations here. So here's the EPBO as of December 31st, 2024 and December 31st, 2025. And then I've got the APBO for the same 2 dates. Now, I've already actually gone over these calculations in a prior video. I left my notes here in case you didn't see that video. You need a refresher of how I got these numbers. This number was just given in the problem that was calculated by an actuary. The other things here, I show you how they're calculated from the information above. Now, so let's skip those because I went over those in another video, and let's get to the calculation of post-retirement benefit expense. And we'll start with service cost. Now, I said that it's calculated a little bit differently than if we're dealing with pensions. So how do we go about calculating it? Well, with service cost for 2025, that's the year that we're looking at here. So 2025 for the year ended December 31st, 2025, the service cost is going to be 1 divided by the entire attribution period, which is the amount of years an employee has to work to be fully eligible for the healthcare benefits, which is 10 years. Okay, so 1 divided by 10 times the ending balance of the EPBO. Okay, so 840,000, which is the ending balance of the EPBO right here. So this, if you're wondering where did I get that number from, as of December 31st, 2025, that's the balance of the EPBO. We take that and we multiply it by 1 over 10. If you say, why is it multiplied by 1 over 10? Because 1 year was worked here. So 2025, we're talking about 1 year, and 1 out of the 10 years that is required to qualify for these benefits. So basically the employees this year represented 10% of the work they needed to do to be eligible for these benefits. So we take 10% of the EPBO as of the end of that year. So December 31st, 2025. And so that's 840,000 times 10%. So that's our service cost. Now, the interest cost, and this is where things get a little bit different, okay? So here, when we did the service cost, we use the ending balance, the EPBO. Now, to calculate interest cost, we're not going to use the ending balance of the EPBO. Instead, we're going to use the beginning balance of the APBO, okay? So again, just to clarify, we did service cost, we use the ending balance of the EPBO to calculate that. But when we do the interest cost, it's the beginning, not the ending, beginning balance of the APBO, not the EPBO, okay? This is what confuses students, so hang in there, okay? So the beginning balance of the APBO is the 160,000. If you think about it, this is for 2025. So for the year ended December 31st, 2025, we said, well, what was the beginning balance at the beginning of 2025? Well, the end of 2024, the balance was 160. So if the balance at the end, if the APBO at the end of 2024 was 160, then the balance of the APBO at the beginning of 2025 was 160. Okay, the end of one period is the beginning of the next. So that's where I got that 160 from right there. Okay, so 160,000. Our discount rate is 5%. So we multiply that by 160,000, and that gives us 8,000 for our interest cost. Now, I already said the expected return on plan assets is 0 because this is an unfunded plan, so the company has not set aside any assets to be able to fund these benefits later. So we have expected return of 0. But if there were assets set aside, the expected return on those plan assets, that would actually reduce our post-retirement benefit expense. Now, we said in this example, there's no amortization of prior service costs, no amortization of a net gain or loss, so we don't have to worry about those things either. So in this particular example, the only thing we have going on is we have service costs and we have interest costs. We add them together, 84,000 plus 8,000 is 92,000. So that is our total post-retirement benefit expense for the year ended December 31st, 2025. Now, in terms of making our journal entry, what we're going to do is we are going to debit post-retirement benefit expense for 92,000, which is the amount that we had right here that we calculated. So we debit our post-retirement benefit expense for 92,000. What are we going to credit? We're going to credit the APBO. Okay, we're going to credit the APBO for 92,000.